Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alcana, along with Brianna Valesky, and we have Phil Davis on the line, founder of Phil's Stock World. Phil is a stock and options trading site that provides education for trading novices and strategies for seasoned veteran traders. Phil's a serial entrepreneur and the president of the AM&A consulting firm Delphi Consulting Corp. Hey Phil, we lost you there, but now we got you live on the show. How you doing this morning?
Oh, yeah. Hi, how you doing? That was kind of strange. I thought I was on the other line.
Okay, all right. Well, we're going here, and we got a market that had a nice rally on Friday, a nice rally on Monday. You had your crude oil futures move up as well. What's your take here, Phil? Continuation rally, or going by your tweet, you're getting a little bearish here?
I am getting a little bearish because, frankly, it was a low-volume rally compared to the sell-off that we had. It's essentially a bounce. We're still significantly below where we were, a few weeks ago at the top, which was about 2035 on the S&P. We're heading into a declining 50-day moving average, where the S&P 50-day moving average is crossing below 2,000. And as I guess your TA people would probably know, when you run into a 50-day moving average that's declining, it ends up being significant overhead resistance.
So how you playing it? I mean, is this the area you're taking a short in? If it goes a little bit higher, you're shorting more, or are you just staking your lot here and give us an area where it breaks above, or maybe you'll have to cut the losses and either make another attempt or try it on the long side?
Well, yeah, this morning I sent out a tweet and an alert to all my members, of course. And we were looking at targets as looking at 16,750 on the Dow, 1980 on the S&P. These are the futures, by the way. 43.25 on the Nasdaq and 11.35 on the Russell. And those are our essential lines in the sand. And we haven't crossed under them yet. We're still over them at the moment. But if we cross under them, what we do is we sort of wait for two to cross under, and then the third one we short. And then we look for the fourth one to confirm that our short was correct, or if any of them cross back over, we get out. So we have a very, very small loss window at this stage because we'd rather short at 2,000, but we don't know that we're going to get there. We have a very, very small window for losing money and a very, very large window for making money. So when we have a very positive risk-reward scenario like that, we like to play it.
All
now,
right.
the same logic could apply to going long over those lines. But on the whole, we're generally bearish. We don't really feel this rally. There's a lot of factors going against it, especially there's horrific factory order news from Germany and Spain today. Really bad data. Japan's been terrible. All the data's been terrible. All this is sort of like hopefully, this is one of those things where the news is so bad that people think we're going to get more free money. And that's the basis of a rally right now. And that's a terrible reason to have a rally.
Okay, I just had a question here about how do you explain, shorting this recent rally, and I think you just covered several reasons why, with the low volume, conviction, factory orders, things that are another fundamental things. I like the fact that you're picking an area, and if you don't get, double or triple confirmation, then, you can cut it loss. We talk about that a lot of times that, if you are making a trade in a particular area, hey, give yourself parameters to get out of it because you may be right, just may not be right at that time. Take a couple shots.
Absolutely. I mean, we flipped. I mean, we were long off of the 1850 line on the S&P. So this is us turning short. So I don't want people to think that we're not permanently bearish. We're bearish now that we're back at this level. We weren't bearish at 1850. 1850, if you look on our chart from this morning, the first one on my post, it shows those lines that we've been playing, exactly how we're playing them.
All right, and you're also bearish crude here with long consolidation between 43.5 and 48.74. Finally broke through it today. Now you're a fader here of this move. 49.71. I think you tweeted out earlier this morning. What's your reason for shorting crude oil and how you playing it?
Oh, we are thrilled to be able to short oil at near the $50 level. We're very excited about it. We also, in the same alert, I put out a short oil at 49.50 this morning, and yesterday we started accumulating USO short position as well. That's for our options opportunity portfolio that we run. And at 49.50 already, it's down to 49.15. That's 35 cents. That's $350 per contract, just for the morning. Our hard work this morning, basically. The thing about oil is, why are we up? See, TA people don't understand this. You know, we're fundamentalists, and TA people don't look at the chart and think about why something is happening. And we were in a range. The range was from basically 44.50 to 48.50, and it was a very tight range, and it's been going on for a couple of months. We broke over it, but we broke over it because the dollar fell 1%, and that allowed oil to rise, because relative to the dollar, the weaker dollar causes more dollars per barrel of oil to be a price. So in part, the price reset because the dollar fell. Also in part, though, you have rumors that Russia is coordinating with OPEC to lower prices. These rumors are BS, but it's the kind of thing you float when you want to rally oil. And they're also talking about production cuts in the U.S., which are true, but they're not going to have a very quick impact on what's going on. So you take the reasons for the move and you say, well, how much gas does this kind of rumor really have? How much is going to move the market compared to the very, very harsh reality of today's 10:30 oil inventory report, which is not going to be pretty for the bears. And in addition, in 10 days from today, no, I'm sorry, not 10 days, 2 weeks from today, you're going to have the contract rollover for oil, and those contracts have to be dumped within the next 2 weeks. All the open contracts for this month have to be dumped in the next 2 weeks. And that's going to cause a lot of selling pressure. So those are the fundamentals.
Okay, you got the fundamentals, you got the technicals covered. Also, China. That's not something you're real bullish on.
Actually, no. China. If you say today, I don't want your readers to get the wrong, your viewers to get the wrong impression, because China today is going to pop because they've been closed for a week. The mainland Chinese market's been closed for a week. The Shanghai Stock Exchange. So when they open tonight, they're going to pop to catch up to everybody else, because they closed basically on the day when we were at the bottom last week. And when they open back up, they're going to have like a 5 to 6% catch-up mode, just to get caught up to where the rest of the world markets have gone in the last week since they've been out. But then we want to start shorting them. So basically tomorrow morning we want to short the China rally if it's still lasting.
Okay.
And the reasons are the same. I mean, look, China's not in good shape. There's no good data coming out of China. And by the way, my overall short on the market, it's because fundamentally we're just not earnings. We have a chart of this in the Morning Post. Earnings aren't that good. If the market were at 1850 or under 1850 on the S&P, I'd be arguing that it's fairly priced and that we probably should be buying more stuff. But when you're up at 1950 or 2000, it's 10% too high. It's very simple. You know, it's just we're too high to justify the earnings that are being reported. And people who are going bullish right now, coming into this earnings season, think about it. Are oil companies going to be reporting good profits?
Nope.
That's 20% of the entire market. How could they possibly have had a good quarter last quarter? And then financials also. How could they have had a good quarter? Anybody doing business in Asia, how could they have had a good quarter? And yet you're going to pay record high prices for stocks? That's crazy.
Huh. All right. Any other, industries or sectors you think that, are exhibiting weakness? I mean, the IBB, obviously, the biotech sector has been weak. What do you make of, like, the dogs being bought, earlier this week? Your Alcoas, your Caterpillars, your IBMs, your U.S. Steels. What do you make of that? People just scrounging for value?
I love it. That's my book. And again, it's because fundamentalists. Everybody was looking at the charts and thinking the whole world was going to end or it's all doomed. And we look at the price. When we look at a commodity, we look at the extraction price of the commodity. We went long on silver last week at $14.50, and now it's up around $15.50 or over, or close to 16. And we got out at 16, by the way. But we look at the fundamentals. How much does it cost to extract silver from the ground? What's the overall supply-demand balance for silver? How much does it cost to pull an ounce of gold out of the ground versus current supply and demand balance? these are very simple, fundamental ways to invest rather than just staring at a piece of paper and looking at a squiggly line and trying to imagine where the squiggly line is going to go next without any basis of understanding what's actually happening.
Those lines can...
Obviously I'm not a TA person. I think you may as well cast bones or something like that.
I know. I look at some of these indicators like the Bollinger Bands, and they keep moving. They keep moving away from, like, the stock goes up, well, then it just goes higher. You wait till it gets higher and keep moving away. But seems like you do some technical analysis. I mean, you have to have some technical analysis techniques you like to follow.
I follow TA. Well, we have our own TA. It's called the 5% rule, and I don't know if you have time for me to go into it, but basically it's based on observations and our knowledge of how the trade programs are designed, and using that design.
Go ahead, Phil. We got a few minutes.
Oh, okay. Well, my dad was a systems analyst, and back in the 80s, my dad and I both used to consult with banks to design the programs that are currently these high-frequency trading programs, what they've evolved into. And what I observed in all these meetings, my father was a programming genius. I wasn't. I was just a liaison. I spoke computer and I spoke bank. So I would, sort of sit at the meetings and sort of translate for everybody. And what I observed in going to about 100 of these meetings with 100 different banks, with 100 different plans to how they were going to beat the market, is they essentially all think the same way. And they all end up, even no matter how much customization they want with their programming, they all sort of think about it the same way, and they end up coming up with very similar methods. And those methods tend to converge on lines that we're able to chart mathematically. So although we do chart the 5% rule, it's really a mathematical formula we use to determine the movement of stocks. It's not too unlike a Fibonacci rule, but it works based on the computer age. Instead of the, Fibonacci was more for natural numbers, whereas we're looking at what happens inside a computer when people try to do programming tricks to move the markets. And at this time, when a market's 90% traded by robots these days, it's really, really effective way to follow the markets. But as to TA, the only reason we look at TA, like resistance and 200-day moving average, is because fundamentally, more than half the people trading the market follow TA. So it becomes, to some extent, a self-fulfilling prophecy. If everybody believes that a declining 50-day moving average is going to cause overhead resistance at a certain point, and it's psychologically 2,000 on the S&P is a psychological point of resistance, then we can tell you that the run from 1850 to 2000, which is 150 points, will retrace back to 1970 at least, and probably to 1940.
All right.
So if you want to know what's going to happen, that's what's going to happen after we touch 2000, if we get there at all.
And is there anything you like, anything on your buy radar?
Well, like I said, we're heavily invested in materials. In fact, what happened is we cashed out all of our winners about a month ago from our long-term portfolio, and that left us with basically nothing but material stocks. So we've had the best time during this rally, though, of course, because finally our material stocks are starting to take off on us. And we still think there's a lot of bargains in that space. There's a lot of miners that are cheap. Gold is still very cheap. ABX Barrick Gold is a very, very good stock to buy at this point. Cleveland Cliffs, CLF, is another good one to buy at this point. Freeport McNamara, FCX, another good one. So you have so I'm covering copper and gold and steel.
Well, if you're buying those commodities, those kind of stocks, then aren't you kind of looking for the economies around the world to pick up and increase growth, increase demand? It seems kind of contrary thinking.
No, because QE, top-down quantitative easing has failed. Is failing, has failed, is not doing enough to stimulate the global economy. The next round of stimulus is going to have to be some kind of bottom-up stimulus, like infrastructure spending, that actually creates jobs and builds things and uses materials. So we're looking for that to be the next round of stimulus as the economy falters into next year. We expect the markets to be pretty flat, but what's going to happen is that the stuff that's been riding high is going to start coming down, like NASDAQ stocks and S&P stocks are going to start coming down a bit, while the material sector is going to come back, and oil is going to kind of normalize next year, probably in about the $50 range.
We're not going to get.
OIH is another good one. The oil services.
Well, I mean, if the Donald gets in there, we're not going to have any of that.
Oh, if the Donald gets in, just leave the country. I don't know where it'll be safe, but just get out. That's
Just,
good. It can't happen. I'm sorry. I don't care. I don't. It's just not going to happen. For one thing, there's not a single Democrat on the planet who's going to vote for him, and I'm sure about at least 1/3 of the Republicans won't vote for him. So therefore, he can't be president.
okay, all right. So, any just final words of advice? I mean, you've expressed your short side here, or a potential setup for some shorts. Anything else you'd like to add for our listeners?
Cash. We like cash. Cash is a very good thing right now. It keeps you flexible. It allows you. You can put. There's thousands and thousands of stocks that are still trading at their 52-week lows right now. So if we pop over 2,000 on the S&P, then we can get more bullish. But as we're at 2,000 on the S&P right now, the best thing to do is have a good amount of cash, stay flexible, and if we have another big dip in the market, that's going to be the time to pick up bargains like on Apple or somebody like that who gets cheap, or IBM who gets cheap.
All right, we've been on
If
the
not,
road.
then but if we go over, then the material stocks are going to start doing great again.
All right, couple scenarios for Phil Davis, founder of Phil's Stock World, employing fundamental analysis, and he is attacking the markets with a passion. We enjoy that, Phil. We love aggressive traders, people that are not unwilling to stick their neck out, make some calls. That's exactly what you did on the show today. We'll keep an eye on them. Have a great day. We hope to speak to you again soon.
Oh, thanks very much. It's been great talking to you.